Yo, what is happening, trading family? It's your boy Wildcard, and if you woke up this morning and your phone was just screaming red from Seoul, don't worry. You are not alone. The tape is already rewriting everything from midnight, and I've got a fruit punch rockstar in one hand and a system that's telling me to hold the line. My man TB is here, as always, quiet and dangerous. TB, what's the first thing you saw on the board?
The KOSPI, down 9%. Not 4, not 6, 9. That's a circuit breaker in any developed market on Earth. Quick reminder before we go any further, nothing we say on this floor is financial advice. We're two guys with strong opinions and a green screen. Do your own research, manage your own risk, and always know your exit before you enter.
And that exit might be getting tested faster than anyone expects this week because the floor didn't just shift. It cracked. Futures right now, the SPY is hovering at 755, inside the range it carved last week, 748 to 765. The VIX is already up at 16.3, which tells me the smart money was buying protection before the headlines even hit. Oil is ripping, up 3% overnight, and the real story is sitting in Seoul at 3 in the morning. KOSPI minus 8.95%. That is not a bad day. That's a leverage blowup. So we're going to walk you through everything. The overnight wreck, the carry trade unwind that hasn't finished, bank earnings tomorrow that look like a trap, and why Wednesday CP. I could be the third domino in a 48-hour macro gauntlet. But first, the plumbing. TB, give them Asia and what it means for our open.
Asia was a split screen. The Nikkei dropped 1.92%. The Hang Seng actually caught a tiny bid, up 0.16. Shanghai fell 2.06. But the print that matters is the KOSPI, 8.95% to the downside. That's not just a regional sell-off. It's an unwind ripping through leveraged retail products in Korea, the kind of single-stock semiconductor ETFs that got way too popular. The won has been bleeding since early July, and when you combine that with a dead ceasefire and a dead U.S. senator, the margin calls cascade. The yen was steady on the surface. Dollar yen up 0.25%, dollar index down 0.1. But below the surface, the one weakness and the leverage unwind are the pipes that matter. Europe, flat. The DAX up 0.13, the FTC up 0.03, Euro stocks down 0.03. They're waiting. The real test is Tokyo, opening in just over 5 hours. If the Nikkei follows Seoul, the carry trade unwind jumps the border and SPY futures break 748 before the U.S. cash open can price it.
That's exactly the mechanical link I want to hit, because SK Hynix ADRs are in a discount spiral with Seoul, and if Tokyo opens down 3 or 4%, every semiconductor name with Asian exposure gets repriced. But let's go deeper, because the KOSPI unwind is not just a Korean problem, it's the first domino in a 3-day macro trap, and it all starts with what happened over the weekend. We've got 3 massive stories. The ceasefire in Iran is dead, U.S. strikes have resumed, and Senator Lindsey Graham is gone. TB, I'll take the political angle on Graham. You dissect what the KOSPI is actually telling us about global leverage.
Good split. Start with Graham.
Lindsey Graham wasn't just a loud voice on defense. He was the guy carrying the secondary sanctions package on Russia, the kind of bill that forces Treasury to label entire sectors as off-limits. That bill is now in limbo. No clear shepherd, no timeline. For markets, that means policy uncertainty just spiked in the worst possible week. If you're a bank modeling Asian counterparty risk, you now have to price in the chance that sanctions don't escalate, or escalate twice as hard depending on who takes the reins. That's the kind of unpredictable that loan officers hate, and it's landing on top of a military escalation that's already pushing oil higher. So the geopolitical shock premium isn't just in the energy complex, it's in the credit spread, in the lender risk models, and in the quiet insurance names nobody's watching.
And that's exactly what the KOSPI is already pricing. Korean retail got levered into single-stock semiconductor ETFs, the same kind of REX-style products. That blew up retail in the US a couple of years ago. When Seoul tanks 9%, those products trigger forced selling. The forced selling hits the underlying chips, which hits SK Hynix, which hits the ADR here, which widens the discount, which forces more selling. That's the feedback loop. But here's the bigger point. This unwind doesn't stop at the Korean border. The Korean won has been bleeding since July, which means carry trades funded in yen and won are getting unwound in Tokyo and Taipei next. The Nikkei hasn't opened yet. The SPY is still inside last week's range, 748 to 765, because it's pricing Friday's news, not Sunday night's. When Tokyo opens in 5 hours, and if the Nikkei drops 3 or 4%, that 748 level is the line in the sand. If it breaks, the denial ends and the cascade accelerates.
I do push back on one thing. Tokyo might not follow cleanly. The plumbing is different. Japan has less of that leveraged retail single-stock fever. It's more institutional, more domestic. So if the Nikkei only drops 1 or 2%, the SPY bounces off 748, and we get to buy the dips open. And honestly, that's the most dangerous scenario, because then everyone piles in thinking the worst is over, and then CPI drops hot Wednesday, and you get a double pump fake that catches way more people than a clean gap down. The trade this week isn't short or long. It's optionality. The VIX at 16.3 is probably underpriced for what's lined up, but we're both sitting on our hands. TB, you said your wave trader algo hasn't added in a week. What's it seeing?
5 positions, 15 slots open, last entry a week ago. The system's basically saying, I'll wait. And honestly, my gut book is 0 for 3 on attempted ads this month. The algo is smarter than me right now. It's holding BYD from a June entry underwater, and it's not adding until the data clears. This week punishes heroes. So the system is telling me 3 catalysts in 48 hours. KOSPI tonight, bank earnings tomorrow, CPI Wednesday, and all of them lean toward higher volatility, higher oil, and a macro repricing. That's not coincidence. That's a setup.
A setup where the first domino already fell at 3 a.m. Seoul time, and the second falls tomorrow before the open. Let's go to earnings, because JP Morgan, Bank of America, Goldman Sachs, Wells Fargo, and Citi all report pre-market Tuesday. TB, I know you think this is a trap. Walk me through why.
JP Morgan is at all-time highs going into this print with a golden cross narrative. The 50-day moving average crossing above the 200-day. That's the kind of technical setup that attracts momentum. But the hidden variable is loan loss provisions. The energy shock from oil at $78, the KOSPI unwind hitting Asian counterparty exposure, and the debt sanctions package all mean that the commercial loan books at these banks are facing a risk. That wasn't in the models 2 weeks ago, when the ceasefire was still holding. If Jamie Dimon says we're adding to reserves, the earnings season will save us story dies tomorrow morning. And if he mentions specific Asian exposure, Korean counterparties whose hedge fund partners just got blown out, that becomes the warning shot for the whole sector. I'm leaning trap, not catalyst.
I'm with you, and I've got skin in this one. Specifically, Bank of America. My TFT algo is holding 22 shares of Bank of America across both accounts. Entry, around $59.38. Current price, just about $59.80. The alpaca side has a stop at $59.17. If Bank of America guides down tomorrow and the stock gaps below 59, that stop gets tested immediately. I'm not going to front-run my own system. It'll do what it does. But I'm watching that level like a hawk. The KOSPI wreckage is already on Jamie Dimon's desk. He knows which of his commercial borrowers were hedging through Korean desks. That second-order effect isn't priced into the earnings estimates because the sell-side models still have ceasefire holds as the base case. It didn't.
Right. And even if the numbers are clean, the guidance language matters more. A phrase like, we're monitoring our Asian exposures from any of these CEOs will hit harder than a miss. The trap isn't just the print, it's the conference call, and that lands right before Wednesday's macro trigger.
Which brings us to the economic calendar. Because Wednesday is the headline event, nobody's positioned for in the context of the other 2 dominoes. TB, break down CPI and why it resets the whole deck.
Wednesday, July 15th, we get the Consumer Price Index, CPI. Core month-over-month consensus is 0.3%, up from 0.2 prior. Core year-over-year consensus is 2.9%, same as the last print. Headline month-over-month is expected -0.1%, after a big 0.5 prior. So the headline number might look benign because of base effects, but the core is where the danger is, and the context has completely shifted. Oil is up 10 weeks in a row, food prices are squeezing because of El Niño in the Iran conflict, and Fed Governor Warsh has made it clear the central bank isn't pre-committing to anything. So a hot core CPI, even one that meets consensus, becomes dangerous because the Fed can no longer look through energy and say it's transitory. If banks guide down tomorrow and CPI prints hot Wednesday, you get a 1-2 punch that breaks the soft landing thesis. That's the third domino. We're also watching Christine Lagarde speak Tuesday and Wednesday from the ECB, China GDP, UK GDP later in the week. All of that feeds into the global growth scare.
And the China print could be the wild card inside the wild card. China Q1 GDP expected at 0.9% quarter-over-quarter, down from 1.3. That's a slowdown, right when Europe's outlook is getting cut and Germany's bonds are sliding. It all feeds the macro trap. So we've laid out 3 sequential hits. Asia leverage unwind tonight, banks tomorrow, CPI Wednesday. There's only one clean place to hide, and that's the commodity complex. Portfolio hot news, energy and food are the only clean trades in this tape, and there's a quiet loser nobody's talking about. TB, what's the energy story?
The sector board last week was clear. The energy sector ETF energy was the leader at plus 3.49%. Oil is up again overnight, and Exxon posted a massive profit surge, $3.7 billion, on the back of the Iran supply fear and the Saudi premium. The bull case is simple. Geopolitical risk isn't going away, supply chains are fragile, and energy stocks haven't fully priced a sustained $78 oil environment. But the bear case is that headline risk before CPI and bank earnings makes any entry hot. My wave trader algo hasn't added, and my gut book is sitting in cash. No call out from me. I'm watching a commodities, DBA, and wet because the food squeeze is a slow fuse. But I'm not clicking buy until I see USTA data and how the CPI number lands.
Same here. My paper account has $9,891 in cash. Nothing screaming at me before CPI. But the name I'm watching that nobody's talking about is Chubb. It's bleeding in my TFT algo. Unrealized loss of $1,165. Insurance is the quiet liability in a war shock. Everyone focuses on oil and defense, but ships sink, bases get hit, claims go up. Chubb's red ink is a contrarian tell that the war's cost goes beyond energy. And if bank earnings tomorrow hint at loan loss provisions tied to energy borrowers, the insurance underwriting cycle could get hit next. That's the second order thread I'm pulling.
Good point. It's the cost the models don't catch because piece was in the training data. My system data is stale from Friday, but the tape doesn't need it. The KOSPI told us everything we need to know about risk repricing. No callouts from either of us. Sitting in cash is a position this week.
Exactly. And that brings us to sector rotation, which confirms the story. Quick look at the 1-week board. Leaders are the energy sector. ETF. Energy plus 3.49. The tech sector. Technology plus 2.87. XLC Communication Services plus 1.86. Laggards. XLI Industrials down 1.08. XLV. Healthcare down 1.7. XLB Materials down 2.15. What's the signal, TB?
Money is hiding in energy and staying in tech as a relative safe haven, but the real rotation is out of cyclicals, industrials, materials, healthcare, ahead of CPI. That tells me risk appetite is fragile. If energy pulls back on profit taking, there's no bid underneath. The laggards are the canary. And with Tokyo opening in hours, that canary might stop singing.
So here's what we're watching tomorrow. First, the Tokyo Open, the Nikkei. If it follows the KOSPI with a 3 or 4% drop, SPY futures will test 748, and the denial ends before the U.S. cash open. Second, bank earnings. JP Morgan and Bank of America especially. Loan loss provisions, Asian exposure language, and any guide down on energy borrowers. Third, the SPY 748 level itself. That's the line from Friday's dip buy. If it breaks, volatility accelerates. And fourth, Wednesday's CPI. A hot core number completes the 3-day trap. So check your stops, know your exits, and remember, sitting in cash is a position. This market punishes heroes, and the next 48 hours are a gauntlet. Trade smart, stay dangerous, and we'll see you back on the floor. Wildcard and TB, signing off.